Hi, I'm Tim Katt, and at this rate, I'm going to have 3 oversubscribed term sheets, but I'm not even starting a company.
Hi, this is Kapoor, and Tim, it looks like you made a new friend at Tiger Global. This is The Rundown.
By the end of 2022, non-traditional tech investors like hedge funds and mutual funds will have invested more in tech companies than traditional VCs. Jay, is this the end of the software-oriented VC?
Tim, I think that statement is largely true, and we have to consider how exactly we got to where we are today, where funds like Blackstone and Tiger can compete with the largest VC funds. 10 years ago, investing in software and SaaS was a risky business because cloud infrastructure wasn't totally figured out, and we didn't understand how these companies could grow into billion-dollar or enterprise scale. Well, fast forward 10 years of data later, and we have now figured out all the new SaaS metrics. We understand net revenue retention, and we understand how these companies can grow top down or bottoms up. So the checks that are going to win are not VC dollars, but the ones that can move with the largest check size and can move the fastest to enable these companies to grow. So where VCs need to go is where their dollars can actually be benefited by the other thing that VCs provide, which is advice and support. And those are areas like space, sustainability, climate change, even crypto and NFTs. These are risky assets where the risk isn't fully understood or priced out, and venture capital can still succeed. Because I think if they start to go head to head with the Tigers and the Blackstones of the world, they're not going to win on dollars alone.
Jay, I'm actually going to disagree with you a little bit because I think it's just the beginning of the software-oriented VC. If anything, this stat is an indication that there's more dollars being invested in the private market. And yes, it is because some of the risk on these enterprise SaaS deals is lower and the opportunity to take them public is greater in terms of a return. But one thing to focus on is these companies still need that seed stage investment. And so seed stage is really immune, and there's more investors than ever coming in and participating at the seed stage, whether it's angel syndicates or solo capitalists or these micro VC funds. And so they still have to evaluate on a basis of the team, how much capital is needed, what the trajectory of that category could look like. And so maybe on a total dollars basis, some of the investment into software is going down in venture capital. But on a number of deals standpoint, it's absolutely going up. And there's still so many categories that are untapped by software when we think about things like healthcare or construction. So I really think this is just the beginning. There's going to continue to be more dollars put into venture capital in the private market as a whole, and software is going to take the lion's share of that.
So Tim, CVC Capital Partners and La Liga have agreed upon a 50-year deal that gives the private equity firm an 11% stake in the Spanish soccer league. We've seen that teams have made good private investment assets, but are sports leagues a good asset for a private equity firm?
Yeah, well, first, I think we need to take a look at why this is happening. And certainly COVID has accelerated this trend of private equity firms being interested in leagues and team properties. And it's actually allowed and forced kind of the teams and leagues to listen because they haven't had the type of revenue that they've had historically because of no fans in the seats. Looking at the team side, I think it makes a lot of sense for an owner to take on a private equity investment because the parameters are so specific, right? They're not giving up a majority interest in the team. It's allowing them to free up and take some chips off the table without having to sell the team to maybe another individual who's going to have a different direction they want to take the team or other ideas at the table. So I think it makes sense on the ownership side. Now, the leagues, that's a whole nother dynamic to look at because it's no longer individuals at play. I think for La Liga, again, going back to COVID, they needed to take some capital in, and going with a partner like CVC, a private equity firm, made the most sense to do it quickly.
You have to think about what's been happening with La Liga over the last year and a half when there have been no fans allowed in the stadium and the seasons have had to shut down for a time because of COVID. And private equity, has been a savior for these leagues because they've needed the cash infusion, but private equity is built on the principles of steady cash flows and bringing costs down, which grows enterprise value over time. The entire bet here is on the media rights, because the media rights is the only piece of La Liga that, continues to generate steady cash flow, especially in a world where COVID could threaten future seasons for La Liga as well. Meanwhile, you have the two biggest teams in La Liga, which is Real Madrid and and Barcelona that are struggling with billions of dollars of their own debt, which would have been okay to service when they were under normal operations. But in this new normal, who knows? So I think the bet that CVC is really making here is that the media rights continue to grow up, because there probably isn't a lot more juice in that lemon from an operational standpoint other than the value of the media. And unfortunately, I think a lot of people believe that despite being one of the most popular leagues in Europe, the media rights for La Liga are in a bit of a bubble. A recent New York Times headline said that even your allergist is now angel investing. Tim, do we think this is a good thing?
I am all for the democratization of investment. One of the core fundamental problems we have in venture capital is the lack of diversity of investors out there. And so this is one way for that to change. And one reason that's true is, the SEC took away the requirement of that $1 million accredited investor net worth threshold. And now you can actually go take a test, which shows you've kind of educated yourself and you have the ability to go invest. These new tools that have come out, like AngelList as a platform, or other tools that power some of these angel groups, have been a great way for people to get exposure to deals and participate. And I think we all want to, right? Because we've had an iPhone in our hands for over a decade now, or we've been on Facebook and we've seen these companies grow, and people come to us with new ideas. And so the more that new ideas can be funded, can lead to more innovation and can really help transform the world. That's why you and I both love venture capital so much, and I'm excited to see other people get involved.
I think the two reasons that angel investing was such a gated community for a long time was education and access, and I think you addressed both of those points. The education piece is you're able to go on YouTube or Twitter or reach out to potential, co-angel investors directly to share and find those deals and to learn about how you evaluate them. I think the platforms you mentioned are also a great example that are democratizing access and enabling people to find deals that are outside of, let's say, just their own immediate network, which may or may not be the kinds of deals that they want to back. Now, so long as that education extends to understanding that these are highly illiquid assets that take a long term to mature, I think you're right. It is great for a lot of people to get involved with having venture capital and angel investing be a larger portion of their overall portfolio. The reason you also have to consider is where is the alpha in your portfolio really coming from, right? The public market stocks, they continue to be on a high, but are you really finding a lot of alpha there? Debt interest rates are so low that, you're not really putting your money into a debt fund. God help you if you understand what makes the crypto markets move. And real estate, I think a lot of people still have a bit of a hangover from the '08 crash and the bubble there. And so even if they are investing in secondary real estate, it's not a large portion of their portfolio. So where you're left is private equity, and you probably can't get into Apollo or Blackstone. So you come down to doing early stage angel investing. So long as folks are educated and understand that that these deals are illiquid, it is a great investment, and it is a great way for new companies to get funded.
Well, Jay, last month UTA signed a deal with venture capitalist Alexis Ohanian to represent him as talent. Tell me, why are Hollywood agencies signing tech execs?
Tim, I think this has less to do with Alexis being a VC or a tech exec and more to do with him becoming a new kind of digital influencer. You have to consider that UTA has been signing TikTok stars, YouTube stars, Instagram stars, and now it looks like Twitter stars or VCs who have become a new kind of content creator. And the reason for that is that the business model of these agencies has also been changing. For a long time, in order to access actors, musicians, athletes, you had to go through an agency. But with digital media, if you want to get an endorsement deal signed by an athlete, you can succeed by sliding into their DMs. We know portfolio companies that have had success doing that. And so in that aspect, the agencies, in order to stay relevant, have to go and find new stars to sign up. And in this case, that means digital influencers. And Alexis is certainly that. I mean, he's done work with social justice issues. He has, been a part of the NWSL's growth. And then obviously he has his day job as a VC beyond just being married to one of the most recognizable stars in the sport of tennis. And so I think from that aspect, you have to consider that UTA is looking at this as just another influencer opportunity.
Yeah, I definitely agree with you on the expansion of personalities, and especially in Alexis's case, all the different things he does beyond investing. But I do think this points to a broader trend that's happening in venture capital, driven by both the need for more transparency and just competition in deals. And so we're seeing more and more VCs, ourselves included, put themselves out there because we want to try and grab the microphone, show founders what we stand for, and that we're available. And there's too many other options out there for funding, quite frankly. And so we're trying to build up an audience so that founders see us, generates more deal flow for us. There was also this narrative for a long time, and it still exists, a tension between media and venture capital, most notably with Andreessen Horowitz, where venture capital was villainized. And so to be able to kind of control the narrative, that's why Andreessen built out their media arm, or that's why the All In podcast exists, is because those investors out there, again, want to be seen for what they stand for and want to have a clear point of view that resonates with founders and as a result brings them new deals.
Well, Tim, I'd like to pretend that we knew that we would become influencers when we started doing this rundown. But listen, if you're out there, CAA, WME, UTA, if you've got an acronym, we're ready to be signed. So, drop us a DM. In the meantime, we just want to thank you all for joining us on this week's rundown. We'll see you guys next week.